Today we're going to be looking at Canadian stock market and we're going to pick top 5 dividend stocks that I invested into and I think everyone needs to. Hello everyone, my name is Alex, welcome to my channel. I hope you're doing well, I hope you're staying safe, and I really hope you are excited as I am because today we're going to be talking about dividend stocks on a Canadian stock exchange. And on this channel I'll talk about personal finance, invest in dividend stocks, stock market, cryptocurrencies, how to get your finances together, and what are the best ways to financially secure your life. And if you like any of those, subscribe to my channel and let's get started. I think Canadian market, specifically Toronto Stock Exchange, is not very popularized to all the retail investors like you and I, and it's not very clear what are the best stocks out there that we need to pick in order to invest on our own. And stocks or ETFs or dividend stocks or growth stocks, any of those. And today we're going to be drilling down into dividend stocks specifically. And the interesting part here is that most of these stocks are also priced on the New York Stock Exchange in the US. So my US friends, you can invest in those too. And as for my Canadian friends, your TFSA account should be your number one choice where you want to hold all these dividend stocks, because you're not going to pay any taxes at all. Not on the dividends, not on the growth, any of those. Then goes your RSP account. That's if you don't have enough room on your TFSA, the second choice would be your RSP account. And for your RSP account, you're only going to pay taxes when you actually withdraw from that account, which is generally going to happen somewhere close to your retirement age. And choice number 3, if you don't have enough room left on your TFSA or RSP account, would be your margin or your unregistered account, where you're going to pay taxes on all the dividends and on all the growth you're getting from your investments. And before we even dive in and look into our stocks, there are 6 parameters you want to consider when you pick dividend stocks. And the first one is market capitalization or market cap, which is the total value of the company. And the formula to calculate the market cap is actually pretty easy and straightforward. So you get the total number of shares that the company has. Say for our example, it's going to be 100 shares, right? And then you get the price per share. So say it's going to be $10. And then, so the market cap of this company is going to be 100 times 10 is going to be $1,000. And the next parameter is dividend yield. And my target for today is going to be 4.5% or more. But remember, dividend yield is not the only thing you want to look at. You also need to consider what is the risk of this company. So the higher the dividend, the higher the risk. And the next parameter is payout ratio. So what it is. So payout ratio is how much money the company actually pays out as dividends from all the earnings they're getting per quarter, per month, whatever. And we generally want to see that number being lower than 100%. I would say around like 50 to 80%. And why? Because we don't want the company to pay all their earnings as dividends, because that would mean that they're either going to cut their dividends somewhere in the future, or they're experiencing a very bad timing right now, meaning that their earnings drop significantly. And parameter number 4, we want to look at 10-year growth. Why 10-year? Because we are long-term investors and I want to see positive market appreciation for all my dividend stocks on the long-term period. And I'm being a little strict on the parameter. I'm looking at 40 to 50% of market appreciation on the last 10 years. As usually, high dividend stocks are not getting a lot of market appreciation, but there are some that do. We'll talk about them in a bit. And the next parameter is beta, which is the risk of our stock. And my target here is from 0.8 to 1.2, 1.3. So it means that I want to see stocks that are less risky, up to 20% less risky on the stock market, and up to 20% more risky than the stock market. And last parameter is drip amount, which means that how much dividends or how much money you want to invest into the stock to get your dividends automatically reinvested back to the stock. And because we're new to dividend investing, I want to see this parameter to be as low as possible so that we can see these dividend reinvestments as soon as possible. We don't have to invest a lot in this stock to get our dividends reinvested automatically back. Alright, so now we can actually start. So very first one is Bank of Nova Scotia, BNS.TO, or just BNS on the New York Stock Exchange. And Bank of Nova Scotia is Canada's 3rd largest bank. And similar to its peers, Bank of Nova Scotia also experienced a pretty bad market downturn in 2020. The value dropped by 25 to 30% just last year alone. However, it did manage to keep their dividends stable and continue their crazy payout streak. The bank has also been paying dividends to its shareholders for the last 180 years. That's crazy. And if you are a long-term investor, long-term dividend investor like myself, right now, one of the best times to pick this stock and to add it to your portfolio. First, for its high dividend. Second, for the low price that hasn't recovered yet since pandemic started. And third, for its balance sheets and a great payout ratio. So let's sum it up into our parameters. So the very first one is market cap. It's at $86 billion. So it means that the company is pretty big. So we can consider it as a blue chip stock. So the next one is dividend yield, which is at 5.07%, which is pretty good number, huh? And it's primarily due to the share price being lower than it used to be before the pandemic started. So right now, as I said, one of the best times to actually buy into it and get all these dividends and get all these reinvestments back to your portfolio. Bank of Nova Scotia also increased their dividends just recently in October last year, which is pretty good considering all the pandemic was going on at that time. The next one is payout ratio, and Bank of Nova Scotia has payout ratio of 68%. Which is great, and it's a very good number. So it means that 68% of its earnings it pays out as dividends, and all the rest, meaning 32%, it reinvests back to its business. And the next one is 10-year growth. And Bank of Nova Scotia has a pretty good number there too, which is the 59%, which means that over the last 10 years, the stock price got appreciation for 59%, which means that we get a pretty good market appreciation for our stock price on long term. Now the risk level, our beta parameter, it's at 0.88, which means that this Bank of Nova Scotia stock is 12% less risky than the average stock market. So if you add it to your portfolio is going to become 12% less risky than it is right now. Now the interesting one, the DRIP amount. So if you want to reinvest all the dividends you are getting from Bank of Nova Scotia, and with this dividends automatically purchase back a single share of this stock, you would require to invest $5,700 into Bank of Nova Scotia, which I would say is somewhere in the medium range. And because the dividends are paid on a quarterly basis, it means that you're gonna get 4 free shares of Bank of Nova Scotia for free from your dividends every single year, which is pretty good, I would say. Let's move on to the next one, and it's Enbridge, ENB.TO on TSX and ENB on the New York Stock Exchange. And Enbridge is a Canadian leader in delivering energy. As a transporter of energy, Enbridge operates the world's largest crude oil and liquids transportation system. The company has also significant involvement in natural gas gathering, transmission, and midstream businesses. The majority of the company's earnings and cash flow are coming from their tolls and fees they're collecting from their delivery services that they deliver to their customers. And that's gonna be there forever. Everybody needs energy all the time. And the good thing about Enbridge that they continue to expand into renewable energies like solar, wind, and geothermal power. Enbridge has been paying dividends uninterruptedly for the last 66 years, which, if you think about it, is a pretty incredible number. And meanwhile, they've been increasing their dividends every single year for the last 26 years. That's pretty incredible too. The company operates at low risk, highly regulated business, allows them to have predictable and stable cash flow, and that allows them to pay and increase their dividends year over year. Alright, let's look at our metrics. So the very first one is market cap, and Enbridge is at $89 billion, which means this company is pretty big and it's not going anywhere. And next one is yield. Okay, hear me out here, is at 7.59%. This is pretty incredible. It's one of the highest paying dividend yields right now on the Canadian Stock Exchange. So the next one is payout ratio, and this is actually pretty crazy. So payout ratio for Enbridge is at 330%, which means they're paying dividends for 3x of their earnings, which is pretty crazy, and I'm not sure how they're actually doing it. But I know what actually happened here is that because of last year, their earnings dropped significantly, but they're still generating this profit and cash flow, so they're still able to pay the dividends back to their shareholders, which is pretty good. And moreover, last time they increased their dividend was in December of 2020, and that's pretty incredible considering all the craziness that's happening on the stock market. They were able to do it, and I would say that's pretty good. And the company is in a good state right now, so it's pretty safe also to get on board with it. And the next one is 10-year growth, and Enbridge is at 53%, which means that on long term, The market appreciation of the stock is pretty good, which comes to our risk, which is at 0.94%, which means this company, Enbridge, is 6% less risky than the average stock market. Now going to our drip amount, is for Enbridge is $2,350, which means if you invest $2,350 into Enbridge, you will be able to get and reinvest automatically back and get a single share of Enbridge every quarter, 4 times a year. So that's pretty incredible, and I would say it's pretty low entry point for your drip setup. And I have Enbridge in my portfolio, and I just invested even more into it to get even more dividends out of it back. Next one is Canadian Utilities, which is a cu.to. Unfortunately, it's not on the New York Stock Exchange, it's only on TSX. So my US friends, you can skip to the next one. But I'm joking, just stay here and listen up, because you might have something similar to it on your exchange as well. So let's see what it's all about. So in the last 12 months, the share price has fallen by 22%, which is pretty crazy. And let's see if we can benefit from it. So a great sign of a good company if it consistently generates strong profits. And Canadian Utilities has no problem at all with it. It does it with ease. Canadian Utilities increased their dividends for the last 48 years, year over year. And it has no problem at all of continuing doing it in the future. It generates almost all of its earnings from the assets that are regulated, which tells us that the earnings are in pretty safe condition right now. And moreover, it continues to invest into regulated and contracted assets, which is even increase their earnings and will give them more opportunities to increase their dividends and pay out their dividends to their shareholders. Alright, let's look at our metrics now. So the first one is market cap. Is at $8.8 billion. So it's not a huge company, but it's pretty stable and it grows consistently year over year. And the next one is yield, which is at 5.44%, which is pretty good. And the next one is payout ratio. And for Canadian Utilities at 116%, which means they pay all of its earnings to their shareholders. And that's mostly due to the last year where their earnings dropped significantly. They're still recovering from it. But right now is one of the best times to actually add this stock to your portfolio to benefit from it. And the next one is 10-year growth. And for Canadian Utilities at 35%, which is not great, but it's still growing consistently year over year in the last 10 years, which is what we need. Now let's look at the beta parameter, our risk level. So it's at 0.57, which means that this stock is 43% less risky than the average market. And you also will be benefiting from the high dividend yield and regular price appreciation. And the last time they increased their dividend was in February this year. So they just increased it. That means they continue their strike of increasing dividends year over year, which is pretty insane and pretty good. And now let's look at the drip amount. For Canadian Utilities, it's at $2,400, and it's pretty easy entrance, I would say, into a drip. So you need to invest $2,400 in order to get all the dividends you're getting from it being reinvested back to its stock and get that free share every single quarter 4 times a year. So moving to the next one, which is Telus, and the ticker is T.to or TU on the New York Stock Exchange. Welcome back, my Americans. And I'll drop it right here that Warren Buffett just invested into Telus. He likes telecoms, and Telus, the Canadian telecommunication company, is one of the best in the North America to invest in right now. And I'm gonna tell you why. And Telus recently partnered with Google to see digital transformation within key industries, including communication technology, healthcare, agriculture, security, and connected home. So this partnership will last for the next decade and puts Telus even further in the lead of telecommunication companies thanks to its established wireline system. And revenue was up 4.21% in the last earnings report, which is pretty incredible. And if you look at the share price, it's only 4.5% higher than the last year, which means that the stock price is super undervalued and has a lot of room for growth. And look at this, if you invested $10,000 10 years ago in Telus, today your portfolio is going to be at $71,500 with dividend reinvested. This is pretty crazy. So the stock price appreciation for this company is incredible. Let's look in details into our metrics. So the first one is that market cap is at $34 billion, which means that the company isn't pretty big, it's not going anywhere, and it's consistently growing year over year. And the next one is dividend yield, which is at 4.67%, which is pretty good for the company like this. The payout ratio is 126%, which is above our limit, but I think the company is pretty safe, and they just increased their dividend just January this year, just a month ago, so which means the company is in pretty good state, and their dividend is not going anywhere. And if you look at the 10-year growth, it's at around 200% over the last 10 years, which is incredible. So you're definitely going to be getting a lot from the market appreciation and collecting the dividends. Our beta parameter is in a pretty good state as well, is at 0.56, which means that it's 44% less risky than the average stock market. So adding this to our portfolio will make it 44% less risky than this today. Now the DRIP amount, so this is pretty low. It's at $2,400, which means that in order to reinvest all the dividends and buy a single share of Telus from your dividends, you need to invest only $2,400. So it's pretty easy entry point for DRIP. And the last one for today is Power Corporation of Canada. The ticker is POW.TO, and it only exists on Toronto Stock Exchange. So I'm sorry, my American friends, it's not on New York Stock Exchange yet. So the Power Corp, best known as a holding company with interest in insurance and wealth management businesses. The assets generate a very strong cash flow and pretty big profits. And Power Corp also invests into new technologies and very promising startups. On the financial side, Power Corp and its subsidiaries hold a controlling stake in Wealthsimple, which is pretty incredible, which is one of the popular brokerages in Canada where you can buy stocks, ETFs, or do your robo-advising investing, or you can even buy crypto, and also you can do your taxes. So all my Canadian friends, if you want to do your taxes on your own for free, I have a video linked above. Go check it out how to do it with Wealthsimple and Simple Tax. It's pretty easy and you get a lot of taxes back. So back to Power Corp. Another investment target for them is EV market, which is electric vehicles market. It has a large position in Lion Electric Company, a Canadian market of electric school buses and commercial vehicles. And once the Lion Electric is going to be listed on the New York Stock Exchange, probably is going to happen sometime in the next month and two, Power Corp is going to own around 34% of it, and it's going to get added to its net value around $700 million, which is going to be probably reflect their share price. So I would say right now is one of the best time to invest in this company. So now let's look at our metrics. The market cap is at $21 billion. So pretty big company, not going anywhere, has a lot of cash flow getting into it, so we're good there. And now the dividend yield is at 5.82%, which is pretty good and crazy for a company like this. So now the payout ratio is at 83%, which means that 83% of its earnings it pays out as dividends, which is pretty good for a company of this size. And also, last time they increased their dividend was in November 2019. So I would say that the new dividend increase is gonna come very soon. So now the market growth. So over the last 10 years, the share price increased by 16%, which is not great. I would say it's mainly just flat at this point, but I think right now the company is at this point where it's gonna start getting higher and higher. And I just added Power Corp to my portfolio just last week. So we'll see where it gets us. So what about the risk? The beta is at 1.04, which means that 4% more risky than the average market. Nothing crazy here, 4% is pretty acceptable. And the final point here, DRIP amount. So for your dividends to get reinvested automatically back to this stock, you need to invest $2,200 only. So it's a pretty easy entry point for your DRIP here, and you'll definitely need to do it to get this dividends reinvested. And that's it for today. I hope you enjoyed it. I hope you learned something for yourself. Get your dividends, reinvest your dividends, and I'll see you in my next video. Like, subscribe, hit the bell. See you around. Cheers. Bye.